$4.5 trillion. That is how much wealth has been wiped from the American stock market in just 35 trading days. And the most shocking part? The people who saw it coming were already gone before you even noticed. Right now, as you watch this, the Dow Jones is sitting at its lowest level in 6 months. 5 consecutive weeks of losses, the longest weekly losing streak since 2022. And the VIX, Wall Street's fear gauge, is flirting with 30. A level we haven't touched since the last real crisis. This isn't a dip. This is a meltdown. Here is what we are covering today. First, I'm going to show you the golden era that made everyone feel invincible, and why that confidence was a trap. Then, the geopolitical trigger that nobody priced in, and how it turned Wall Street's optimism into raw panic. After that, what the institutional giants are doing right now behind closed doors, which sectors they are dumping, and why. And finally, the part that matters most, how this hits your wallet, your rent, your retirement, and your job. The truly terrifying part? I will reveal that shortly. Stay with me. To understand why this crash hurts so much, you need to remember how good things were just 2 months ago. In January 2026, the Dow was trading above 43,000. The S&P 500 had gained over 22% in the previous 12 months. AI stocks were on an absolute tear. Nvidia alone had added roughly $800 billion in market cap over the prior year. Money was flowing, confidence was sky high, and every financial headline screamed the same thing. The bull market is unstoppable. Meet Jay. Jay is a 34-year-old project manager in Austin, Texas. He had about $60,000 in his 401k, mostly in tech-heavy index funds. Every Friday, he would check his portfolio over lunch, smile at the green numbers, and think about maybe putting a down payment on a house by summer. Gas was around $3 a gallon. His grocery bill was stable. Life was predictable, comfortable, and optimistic. Wall Street strategists were forecasting 3 rate cuts by mid-2026. Goldman Sachs had an S&P target of 46,000. The narrative was simple. Inflation was cooling. The Fed would ease, and the good times would keep rolling. But here's the thing about golden ages. They never announce when they are ending. But here is where it all fell apart. In late February, tensions between the United States, Israel, and Iran escalated to a level not seen in over a decade. Military posturing in the Strait of Hormuz, the narrow waterway through which roughly 20% of the world's oil supply passes, sent shockwaves through energy markets overnight. Brent Crude, which had been hovering around $78 a barrel in January, surged past $105 by mid-March. Think of it like this. The global economy is a car and oil is the gasoline. When someone threatens to block the gas station, every driver panics and the price at the pump explodes. That is exactly what happened. And the chain reaction was immediate. Higher oil means higher transportation costs. Higher transportation costs mean more expensive groceries, more expensive manufacturing, more expensive everything. The Consumer Price Index, which had been trending down toward the Fed's 2% target, reversed course. February's CPI print came in at 2.4%. March estimates are pointing toward 2.6%. Inflation, the monster everyone thought was slain, came roaring back. The Federal Reserve, which had been signaling rate cuts, went completely silent. Fed Chair Jerome Powell's March 19th statement was blunt. Quote, "We will not cut rates into rising inflation." End quote. Overnight, the market repriced. Futures on rate cuts evaporated. The probability of a June cut dropped from 72% to just 11%. Some traders even began pricing in a rate hike. Let me put that in everyday terms. Imagine you have been planning a vacation because your boss hinted at a big bonus. You have already booked the flights. Then your boss walks in and says, "Actually, we might need to cut your hours." That gut punch feeling? That is what the market experienced. Jay noticed it first at the gas station. His weekly fill-up jumped from $50 to $71 almost overnight. Then his grocery bill crept up. Then he checked his 401k and saw red for the first time in months. But the real damage was not at the gas pump. It was happening inside the towers of Lower Manhattan. What nobody saw coming was the speed of the institutional sell-off. When the market started cracking, the big players did not wait around hoping for a bounce. They ran, and they ran fast. Over the past 5 weeks, institutional investors have been aggressively liquidating their most profitable positions. And the number one target? AI and mega-cap tech stocks. The very names that carried the market for over a year became the first to be sold. Why? Because when you need cash fast, you sell what has gained the most. It is like owning a house and a luxury watch. When you need emergency money, you sell the watch first. Not because it is bad, but because it is liquid and it is up. Nvidia dropped 12% from its February high. Microsoft shed 9%. The Nasdaq Composite officially entered correction territory, down over 10% from its peak. But here is the shocking part. It was not retail investors driving this. According to Bank of America's latest fund manager survey, 63% of institutional managers reported reducing equity exposure in March. Net allocation to U.S. stocks hit its lowest level since October 2023. Hedge funds ramped up short positions on the S&P 500 futures to levels not seen in 2 years. They were not just selling. They were actively betting on more pain. The VIX, our fear index, tells the whole story. It jumped from 14 in early February to 29.7 by March 28. That is more than a doubling of fear in less than 8 weeks. For context, a VIX above 30 historically signals extreme market stress, the kind we saw during COVID and the 2022 bear market. Meanwhile, money poured into traditional safe havens. Gold hit $2,340 an ounce. Treasury yields on the 10-year note surged to 4.9% as bond prices fell, and inflation expectations climbed. The dollar strengthened, crushing emerging market currencies. Jay tried to buy the dip. He put $2,000 into a tech ETF during week 3 of the sell-off. By week 5, that position was down 9%. He stopped checking his portfolio. The truly terrifying part is not that institutions sold. It is that they have not started buying back. Now, here is where it gets truly dangerous. The market is not just dealing with a sell-off. It is staring down the barrel of something far worse, stagflation. Stagflation is when prices keep rising, but the economy slows down at the same time. It is the economic equivalent of being stuck in quicksand. The harder you struggle, the deeper you sink. The Fed cannot cut rates because inflation is surging, but it cannot raise rates aggressively either, because the economy is already showing signs of weakness. Manufacturing PMI dropped to 48.2 in March, firmly in contraction territory. Consumer confidence fell to its lowest reading since November 2023. Retail sales growth has flatlined. The economy is cooling, but your cost of living is not. Now, let me give you the comparison that keeps economists up at night. If the United States had diversified its energy infrastructure more aggressively over the past decade, reducing Middle East oil dependency to below 40% of imports, analysts at J.P. Morgan estimate that today's gasoline prices would be roughly 35 cents cheaper per gallon. That does not sound like much until you multiply it across 140 million American households. We are talking about billions of dollars staying in consumers' pockets instead of flowing overseas. But that ship has sailed. And now the market is pricing in the worst-case scenario. Morgan Stanley's chief equity strategist warned on March 26, quote, "We are entering a period where traditional portfolio hedges may not work as expected." End quote. Translation: even your safe investments might not protect you. The S&P 500 has now fallen over 12% from its January peak. The Dow is down roughly 11%. Small cap stocks, measured by the Russell 2000, have been hit even harder, down nearly 16%. These are not random numbers. They represent retirement accounts, college funds, and emergency savings being eroded in real time. And here's the twist that should make every investor sit up straight. During the last stagflation scare in the 1970s, the market did not bottom until the Fed made a decisive move. Right now, the Fed is paralyzed. No cut, no hike, just silence. And markets hate nothing more than uncertainty. So, let me ask you directly, how is this affecting your life right now? Because this is not just a Wall Street problem. It is a Main Street crisis. If you drive to work, you're paying more at the pump. If you buy groceries, your bill is higher. If you have a 401k or any retirement savings in equities, your net worth has likely dropped by thousands of dollars in the past month alone. Let us go back to Jay. His $60,000 401k? It is now worth roughly $52,800. That is a $7,200 loss in 5 weeks. The down payment he was saving for? It just got pushed back by at least 6 months. His rent is going up in April because his landlord is passing along higher costs. And his company just announced a hiring freeze. Jay is not panicking yet, but he is scared, and he is not alone. Here's what you need to understand. When institutions sell, the effects ripple outward. Companies see their stock prices fall, so they cut costs. Cutting costs means hiring freezes, layoffs, and reduced investment. That means fewer jobs, slower wage growth, and tighter household budgets. It is a vicious cycle, and it feeds on itself. Now I want you to think about this. What would you do if this sell-off continues for another 5 weeks? What is your plan? Because hoping the market bounces back is not a strategy. The investors who survive downturns are the ones who act before the crowd. Reduce exposure to high volatility positions. Build your cash reserves. If you have debt on margin, close it now. This is not about timing the bottom. It is about making sure you're still standing when the recovery eventually comes. And it will come. It always does. But the question is whether you will be in a position to benefit from it. History teaches us one lesson over and over again. Markets do not crash because of bad news. They crash because of good news that was never real. The bull run of 2025 was built on a promise that inflation would fade, rates would fall, and growth would continue forever. That promise just shattered against the rocks of geopolitical reality. Every generation of investors faces a moment like this, a moment where the rules seem to change overnight. The 1970s had oil embargoes. 2008 had subprime mortgages. 2020 had a pandemic. And 2026 has a toxic cocktail of energy shocks, inflation resurgence, and institutional panic. The Dow sitting at a 6-month low is not the end of the story. It is a question. And that question is simple. Will you be a spectator watching your wealthy road? Or will you be the person who adapted before the crowd figured out what was happening? The market always recovers, but it never waits for the unprepared. If this breakdown helped you understand what is really happening in the market right now, hit that subscribe button and the notification bell so you do not miss the next critical update. Drop a like if you want more deep analysis like this. I will be tracking every move the institutions make and every signal the Fed sends. Next week could be the most important week for markets this entire year. Make sure you are here for it.